Okay, and then I'm going to go ahead and open up our slides for chapter 1 here that we were looking at last time, and put us into slideshow for a minute. Okay, good. And then I got to find my little clicker, and we should be off to the races here. Okay. One administrative thing before we get started. We're going to hand out the sign-in sheet that I mentioned last time. We'll hand that out probably after the break. Okay, so we'll go ahead and hand that out. Make sure you sign in. You'll sign in next to your name under today's date, obviously. You may have to flip through a couple pages to find your name, but make sure you're signing under today's date. You can just initial in the little box there next to your name under today's date. Okay. All right, good. So I'm not going to repeat some of this stuff. We talked about preparing the financial statements for users of the financial statements, and we're really thinking about external users in this class, right? Now, we didn't mention this last time, but when we consider our users, we consider investors and creditors are primary users. Okay, those are primary users. There are a set of secondary users. For example, the Internal Revenue Service could be interested in a company's financial reports. The IRS would be looking at that, not so much for making investment and credit decisions, but because of their tax compliance requirements, they may be interested in an entity's financial reports for that reason. But they are not considered primary users. They are considered secondary users. And when the FASB, remember the people that write the accounting standards, are thinking about what to require companies to put in their financial reports, they're thinking about these primary users. Okay, the secondary users, if they're benefited, fine. But FASB is really thinking about primary users, investors, and creditors. Okay. Now remember we mentioned that the Financial Accounting Standards Board is the private sector standard setting body. Okay, it is a not-for-profit organization in which the Security Exchange Commission has delegated its legal authority to write accounting standards. And they turned it over to the profession because they felt that, hey, the practitioners, the people in the day-to-day involvement, really should be the ones setting the standards. But we're going to take our regulatory overview and watch what they come out with. And from time to time, SEC steps in and says, hey, FASB, we want you to do this. Or they may even issue their own guidance to companies if they believe that is necessary. Okay. Now, we talked about the FASB being a 7-member board. Okay, and that 7-member board, we talked about how they make like $500,000 a year, and they try to get people from different backgrounds, et cetera, to sit on that board. And I think the sense was that, hey, this is pretty important, okay? Where are these people who are setting these standards that tell companies what they have to put in their financial reports, where are they coming from? And the good question was asked. What's your name again, sir? Ramadea? Ramadea? Rama? Okay, I got that far. I'll get the back end. Talk to him about it after. I'm a little hard of hearing, I guess, and I come from Hayward, so I have trouble sometimes. But Rama, you asked the question, which was a very good question, which is, well, who exactly appoints these members? And I kind of danced on that a little bit because I got to look that up. But remember, I mentioned the Financial Accounting Foundation would have some involvement in that. And so let's just quickly, and I've got to get my pen here, remember, or not remember, but realize, because I don't think I said it last time, okay, that when we look at the Financial Accounting Foundation, they have a function in which they are, here's our FAF, Financial Accounting Foundation, and they have responsibility for raising funds for the FASB and for another organization way outside the scope of this class, guys. I won't be asking you this, but my governmental accounting students would be upset with me if I didn't mention the Governmental Accounting Standards Board. That entity sets accounting standards for state and local governments. And the FAF is the foundation that sort of oversees these two bodies and primarily is responsible for making sure that they're getting funding. Now, in the past, before Sarbanes-Oxley, who's Sarbanes, who's Oxley? Who's Sarbanes, who's Oxley? Okay, big deal in the accounting world. In fact, when little children decide they want to become an accountant, instead of playing Marco Polo, they play Sarbanes-Oxley. Sarbanes-Oxley. Okay, what happens? These are two Congress members. Sarbanes was the Democrat, the senator. Oxley was the Republican, the House member. And after Enron happened, they came in with what they call the Sarbanes-Oxley Act, which did a lot of things. Remember, I had Apple's reports up here, and we were talking about the auditors give their report, and there's also a report on internal control in which management says we are responsible for the financial statements, all that. That's in Section 404 of Sarbanes-Oxley. Section 200s have penalties, prison penalties, etc., if entities engage in fraudulent financial reporting. It's a big deal. Okay? And one of the things that happened as part of the Sarbanes-Oxley Act is they said that if you're a public company, you must pay a fee in order to list on the public stock exchanges, and that fee will go to finance the FASB. Trying to remove any conflict, in which used to happen is you would voluntarily give to the FAF to fund the FASB, and you could put pressure on the FASB by saying, well, we don't like these new accounting standards you're coming up with, so we're not going to be funding you anymore. We're going to cut back our funding because we need to slow you down a little bit. So now the funding mechanism is what? Somewhat automatic. Okay? But the FAF still has an important function, thus getting to Rama's question, which is, well, who appoints the members of the FASB? And it is the FAF. The FAF is the entity that looks at nominations, candidates for the FASB, and then gets involved in the process of actually electing those members in that 7-member board. But of course, the next question is, well, where does the FAF come from, right? It's sort of like, where did babies come from, Mommy? It's a long explanation, right? Okay, so the other part of it is the FAF. Okay, now the FAF is basically members of industry that are selected by members of the FAF. So the members of the FAF will do what? Add additional members to the FAF. And they come from different backgrounds, different organizations, different disciplines. Many of them sit on boards of directors of corporations. Okay? Now, do you see a problem with that? What's the problem with members of corporations now appointing members of the FAF sitting on boards of directors of companies? Another conflict of interest. The inmates are once again running the asylum to a certain extent, aren't they? Okay? So you still have this conflict of interest when you got members of boards of directors of companies sitting on the organization that does what? Appoints members to the FASB. And so it begs the question, why doesn't the Security Exchange Commission get involved in appointing the members of the FAF? Well, they have the legal authority to set the accounting standards, don't they? If you're waiting for me to answer, my answer is I don't know. Okay, and this is something that, to me, would improve the process if SEC got in there and at least had what? Some sort of input to the process. I'm sure they probably have input to the process, but we're actually integrally involved in the process, I guess is the phrase I'm looking for, to make sure that these members of the FAF know where their bread is buttered, etc., right? Okay. Now, I posted up on Canvas the bylaws of the FAF, And in there you can see sections for appointment, and you read through that and you're like, how do they decide who sits on the FAF? It looks complicated, and the idea is that they'll pull from various individuals that are qualified to sit on the FAF, but it's the FAF that decides who's qualified to sit there as they put forward these nominations. So it is somewhat of a messy process. Now on there, I said, remind me to tell you a story about the FAF. Okay, so I'm sure you were just that's all why you rushed in here today, was to hear the story about the FAF, okay? So I was on an assignment where Congress asked my office, the GAO, to look at the standard setting process. And in that report, we didn't come right out and recommend that the SEC be involved in appointing members to the FAF, because even an auditor report of the GAO, even though it's a very independent organization, sometimes we can't get too far out in front of the troops and all of a sudden just start recommending, hey, SEC, do this. So we didn't go that far with that recommendation. But what we did was we talked to, as I mentioned last time, members of the FASB. Remember, I said we can only meet with 3 or 2. You can't meet with 4 because that'll set policy. We met with different business organizations, the Business Roundtable, which is a heavy-hitting organization, the Federal Executive Institute, the FEI, the American Institute of Certified Public Accountants, which is the auditor's perspective. We met with all kinds of people on that assignment, SEC, and then we started meeting with members of the FAF. So we went in to meet the chairman of the FAF, and that individual's name was Dennis Dammerman. Dennis Dammerman. Now, Dennis Dammerman was the CFO of GE, okay, General Electric, and so it's a big deal, okay. And Dammerman's claim to fame, by the way, he's no longer with us. He died some years back, but Dammerman's claim to fame was that he had this talent acquisition eye. So he was great at bringing in talent that then flourished in the organization, et cetera. Dennis Dammerman. Okay, so we want to meet with him because he's the chairman of the FAF. And so he agrees to meet with us. And so you go to GE's headquarters in New Jersey, and it's like trying to get into a Department of Defense facility. You have to show your government credential and go through 3 checkpoints, and you've got military people there, the whole works. Why all these military people in front of GE? General Electric. General Electric gets huge Department of Defense contracts, right? And so they potentially have military secrets there, that sort of thing. So you have to go through this whole process. And then we get into Dennis Dammerman's office, and he's got this huge office. In GE, he's the CFO, and they invite us to sit at the little table on the side to wait for him to finish whatever he was doing at his desk, and he's sitting at his desk writing some things, and then he looks at us, doesn't even say hello or anything, goes over, and there's a little crescendo there with fruit. Would you like some fruit? No, okay, and he gets his fruit, and he comes over and sits down at the table with us. So again, we have been talking to, hundreds of people on this assignment, okay, and it's my turn to lead the questioning, and so I'm going to lead this, and I start asking him about different positions that the FAF has had, and I start quoting what different people on the FAF had said. And I said, for example, Dennis Dammerman said this, Dennis Dammerman said that. Do you agree with this? And the guy's looking at me like, what's wrong with this kid? And then he finally goes, I'm Dammerman. Okay, so anyway, that's supposed to be the punchline of that story. No, the build-up is great. The punchline's not so great. Okay, so it was just funny, and that became the mantra on that assignment. Hey, John, who's Dammerman? I'm Dammerman. Okay, so, I screwed up. I was quoting him to himself because I was getting confused of who we had talked to at that point. Needless to say, I didn't get a job offer from GE after that, okay? So his eye for talent wasn't focusing on me after that. But anyway, that was the story about the FAF. But obviously what? They're not people that are just sitting on the sidelines, right? They are actively involved in running their businesses, and this creates a conflict. And I'm of the opinion that SEC should probably take a more active role in the appointment of the members of the FAF. Okay, but you got the FAF, they appoint members of the FASB, and then remember, guys, we said, was there a question on that? I thought I saw a hand, no. And then remember, we said that what? FASB writes the generally accepted accounting principles, and those are used to prepare the financial statements that we'll be studying in this class, mostly the balance sheet and the income statement, but we will talk a little bit about the statement of cash flows towards the end of the class. Statement of retained earnings, statement of cash, stockholders' equity, excuse me, we talk about in the context of something called a statement of retained earnings, and we'll talk more about that. Okay, so what I want to do is just repeat what we had done the other day, which was to go on and we Googled and found Apple's financial reports. Okay, so let's just do that little bit again. It shouldn't take us that long. And to be honest with you, the main reason I'm doing it again is because that's about where the microphone cut out last time. So let's just go ahead and see if we can capture that in case you want to look at it later. So let's just see. Of course, it all is predicated on the internet doing its thing. Okay, good. So, okay, they have, looks like the more current 10K report. Okay, let me click on the 10Q is the quarterly report. Okay. Say it again. Okay, hang on. Let me start over again. So you say I go back here and I do what? Under the year, select year. Oh, okay, great, thank you. Right, okay, good. And you see the 10Q report there? You go to the next page, and then 10K. Thank you, sir. Appreciate that. Okay, so I'm going to just go ahead and open that again like we did last time. There's the 10K, and I think last time we had like some funky year up there, 2008 or something stupid like that. But now we've got the most current 10K, right, because it's an annual report, and 2018 obviously isn't done yet. Okay, now we go to the financial statements and supplemental data, etc. So I'm going to go to that. And the first thing I'm going to go to is the report by the independent auditors, okay? And, geez, we even get a better image this time. And remember, Ernst & Young says that they have audited the financial statements, and notice they come right out and they say the financial statements are the responsibility of who? Management. Management needs to take responsibility for those financial statements. They do this because there has been misconception in the industry over the years that the auditors are responsible for the financial statements. No, it's management. Auditors do what? Come in behind and audit those financial statements and then what? Express an opinion on the statements. And they go through a set of standards when they do that audit, and then they render their opinion. And they're saying, in our opinion, the financial statements present fairly and in conformity with the U.S. generally accepted accounting principles, and we know that FASB sets those standards. So the auditors look to see that the company statements followed the standards, right? And this adds reliability to those audit reports because now we know we had an independent third party that came in and did what? Looked at those financial reports. Now again, we said last time, who pays for the audit? Who paid for this report? Apple paid for this report. Management paid for the report. And you say, well, isn't that a problem? I mean, what happens if all of a sudden we don't like the auditors anymore? Can we change them? Yeah, you simply change them. However, there is a requirement that the new auditor talk to the predecessor auditor and find predecessor is the past auditor, successor auditor is the new auditor. The successor auditor has to talk to the predecessor auditor, and they have to say what's the reason for the change, and they need to consider that in deciding whether or not to accept that new client. The other thing that happens is the partner, the person in charge in this audit, has to rotate under Sarbanes-Oxley requirements every 5 years, so that we know that that partner over there is not only reviewing my work before I can release this report, but will be taking that audit over at some point in time. But if you're feeling a little creepy about this whole process, that's good. You should. There are certain holes in it, aren't there? If you have the auditors being paid by the company that they're auditing, etc. So all of those feelings you have of, wait a minute, isn't there some conflict here, is absolutely the case, okay? All right, now you come over and let's see, I mentioned that there's a discussion of the internal controls, okay? And so the auditors will also give a report on the internal controls. And I'm not sure that we did mention this last time. The auditors will also provide an opinion on the internal controls. Internal controls are things like safeguarding assets, right? You go into a company, and one of the things I tell new auditors, we can have an instant finding. If we take the visitor pass that they've given us, and let's go immediately to where they show us where their secured computer systems are, and let's see if our visitor pass will open that door. And if it does, then what? We have an instant finding, because that should be for only limited personnel that get access to the secure computer areas. And that's just like a very simple thing. We would have to go through methodically, understand the internal controls, and literally test the internal controls to see if they are achieving their objective. And if we find weaknesses, we are to call them out in this report, okay? Let's see. In our opinion, effective controls. Okay, so now you know that Apple has good, effective financial controls, right? Because the auditor gave the opinion on that. And this was something that was brought in by Sarbanes-Oxley. Okay, now that's the auditor's reports. Let's see if I can get back up to those hyperlinks. It's probably the best way to find the financial reports we want to look at. All of this that I'm scrolling through kind of quickly here, guys, are notes to the financial statements. Okay, so it's not just the reports, the financial statements, but there's also notes that explain what's going on with those. So I'm just going to open this up all over again. It's probably the easier way for me to find now where the financial reports are to get me back to those hyperlinks. Okay, you've got a bunch of notes that go along with these financial reports, but let's just take a look at the financial statements, and let's look at the balance sheet. Okay, so on the balance sheet we have what? We have assets, we have liabilities, and shareholders' equity. Now the reason they call it a balance sheet is because it balances. Assets, $375,319, whatever, the 2 years side by side, and then you come down a little bit more, we have our liabilities, and then you come down a little bit more and we have our stockholders' equity. But notice the liabilities plus the stockholders' equity total up to the assets, 375,319. So they call it a balance sheet because what? Assets equal liabilities plus stockholders' equity. That will always balance. If a balance sheet doesn't balance, what do? We beat it until it does. Okay, the balance sheet must balance. Okay, we don't sit there and have an out of balance balance sheet. We would just keep working with it until we figure out why it's not balancing. Okay, now if you come up and you look at the statement of operations. Statement of operations is a fancy name for the income statement. Remember I said the two statements we're going to focus in on this class is the balance sheet and the income statement. Statement of operations is like the income statement. It is the income statement. You have sales, you have cost of sales, you have something called gross profit, gross margin. You come down, you have what? Net income. So it is easy to know where we report net income if we call it the income statement. Net income is reported where? On the income statement, right? And income is roughly defined as our revenue minus our expenses. Okay, we're going to be taking a look at how we would get information into these reports here in this class. So this class is much about procedure. Even though I'm showing you the end product, what we're going to be talking about is the procedure that's going to allow us to be able to create these financial reports that you're talking about here. Okay. All right. Any question on that? Okay, good. So we come over, and I can close this now. And I think that was the part that was blanked out on that other recording, so hopefully we got it now. Okay. Thank you again for showing us where to find that stuff. And then let's go ahead then. And let's start to take a look at our where we left off. Okay, so where we left off, I'm going to come back down. I just feel like some sort of giant up here. Okay, and so what happens when we left? We were on this slide, and we're going to start to look at some high-level guiding principles that FASB uses when it decides a particular accounting procedure. Okay, so these are high-level principles that FASB uses. The first one under our measurement principles being historical cost principle. Historical cost principle says that we will carry certain assets on our balance sheet. Assets are on the balance sheet, aren't they? We will carry certain assets on our balance sheet at their historical cost. So what happens? I buy a piece of land here in Palo Alto, let's say. Okay, do they have expensive land in Palo Alto? Okay, so I bought a piece of land in Palo Alto back in 1975. And let's say I bought that piece of land for $100,000. Now, that same piece of land today could easily be worth what? Let's just say 2.1 million, let's say. Who knows, right? Depends on the piece of land, right? Okay, now, if I were to be using that land in my business, I would still be showing the value of that land at $100,000. Under the historical cost principle, they say you should keep assets like fixed assets, like land, at their historical cost. You don't write them up year to year. You do not write them up year to year. You just leave them at $100,000. Now, the reason they do this is when they're looking at things like land, they're saying that there's a lot of subjectivity into the value of that land. Everybody, what, thinks their piece of land is worth $2 million. Meanwhile, what, somebody else looks at that piece of land and says, I wouldn't even give you the $100,000. This thing is, piece of junk. I can't put any of my business activities on this piece of land, etc., right? So to remove that subjectivity of fixed assets like land, buildings, etc., FASB came out and said you must carry those at their historical cost so that there's no chance that somehow I'm putting down this optimistic value. Somebody comes in, wants to buy my stock, and they think I got a $2 million piece of land, then turn around, what? You try to sell it later, and you can only sell it for even $1 million would be a significant difference, wouldn't it? Okay, and so FASB says keep items like that at their historical cost. Do not write them up above their historical cost. Now, what happens if they find nuclear waste on that land? One day, for some reason, the land feels a little warm, and they do a little investigation. They find out, well, this was used for nuclear stuff is leaking out here or something, right? And so they turn around and they say, this land is only worth zero. In fact, step away from the land. And they put a big fence away from it, and no one can enter it for the next 100 years or something. Now that land is worthless, isn't it? Now FASB will say, okay, then you need to show it as worthless. So you can write it down, but you can't what? You can't write it up above a historical cost. So when we say historical cost, doesn't mean we leave it there even if we determine that the item is worth less than its historical cost. We write it down, but not up. Now remember, when did they create the SEC? 1933, 34 acts, okay, right after the Depression. Do you see how the Depression is like right here in our heads and saying, no, we don't want to overvalue a company's assets because then people are going to be harmed by that. So that's really the orientation of a lot of these rules, okay? Now, We talked about, and I didn't mention them in our quick little review, the International Accounting Standards Board and IFRS. International financial reporting standards will allow companies to write their fixed assets up above the historical cost. So some countries, maybe that aren't as damaged psychologically, whatever, by the Great Depression as the United States are, emerging economies that are looking for a set of accounting standards might be fine with this idea that, yes, you can write your assets up, fixed assets up above historical cost. However, and beyond the scope of this class, guys, you will not show that as an income item on your income statement. They have a different way of disclosing that so that it doesn't end up hitting the income statement. But on the balance sheet, yes, you can write them up above historical cost. And I think the question was, what do you mean by cherry picking? And I gave that example of these are the kinds of things that, you know, well, China looked at this concept of IFRS and said, we don't like that. But other parts of IFRS they did like and they accepted. Okay? All right. So we'll mostly focus on U.S. GAAP in here, but I'll mention differences from time to time where they seem relevant. Okay? All right. Now you notice up here we also have fair value principle. And you say, well, look, if FASB is using the historical cost principle, why are you bothering us with the fair value principle? Well, it turns out that it depends on the asset. So assets like land, building, long-term fixed assets, FASB tells us historical costs. But then they look like something like a stock investment. Can a company have a stock investment? Company A buys stock in company B as an investment, right? For things like investments, like stock investment, FASB looks at that and says, okay, that you can carry at its fair value. Whatever its value is at, say, December 31st, that's what you can carry it on your balance sheet at December 31st, whatever its value is at the end of the year. Why would FASB be willing to allow companies to use historical cost, or I should say fair value, on certain assets like stock investment versus historical cost for things like land? What happens at the end of each day when it comes to securities? They ring the bell. What were you going to say, sir? Well, we ring a bell at the end of the day, ding, 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 and say, this is the value of Apple stock. And everybody says, okay. And everybody agrees. And that's what you're going to have to buy it for. So when there is this what? This readily determinable market value, this what? This objective measure of the value of an asset like stock, then FASB says, okay, we don't have that subjectivity creeping in like you would for a piece of land. We're going to go ahead and do what? We're going to go ahead and let you carry those assets at fair value. Okay, so it really depends on the asset. Longer term fixed assets like land, building, we use historical costs. What? Items like stock that have readily determined fair value, we can carry at fair value. Okay? All right, good. Now, we also have some, yes, sir.
For private companies, they're in between two funding rounds. How do you value them? Like they've made progress since the last funding round, so they're not worth what it was in the last round.
If they are trading, okay, which it sounds to me like that's not what you're talking about, yeah, and they're not trading, then we might have to bring in an independent stockbroker. Let's say I was auditing that company. They can still carry it at fair value. The question becomes how you determine fair value. And when you determine fair value, you have three inputs, okay, that you can look at. Input A would be, what is this thing trading for? Hello. If it's not trading, then we don't have input A. Input B would be, well, what are similar securities or similar items trading for? So we would go to input B in the case of not having input A, and then for input C would be things like future earnings, that sort of thing, to determine its value. So you go with those levels of inputs. And so for me, what I would do if I was auditing this company, it was a private company, I would come in and get an independent stockbroker that would come in and say, okay, what do you think the value is based on what's going on with this particular situation at this point in time? Yeah, but you can still carry it at fair value. It's just the process is a little more convoluted than just looking. You know, it's a piece of cake. If it's a publicly traded company I'm auditing and you hold an investment, I'm going to take the ending per share price and multiply it by the number of shares you've got. I'm done. Yeah. Okay. Yeah. the land itself that it's sitting on would be historical cost, and if you purchased that land a long time ago, then yes, the land that the item sits on is going to be a historical cost. Obviously, you just recently purchased it to construct the asset, then it might be pretty close to what the current fair value is. And then as you build that item that goes on there, some of that cost is considered cost of land versus cost of the building. For example, digging the foundation for, let me back up, not digging the foundation. Let's say I had to clear off an old building to clear that off for your example, the stadium. Okay, that's part of the cost of the land. Anything I have to do to get that land ready for its intended use is part of the cost of the land. And then once I start to dig the foundation for that building, etc., that's part of the cost of the building. And while I'm building that, that is considered construction in progress. And as I pour whatever actual costs are into that, that starts now being part of the cost of the building, the stadium in this case. And then once it's done and I'm finished it, now I have that historical cost essentially, which is what I paid for it as I constructed it. And then we'll talk about depreciation in another chapter. Then I'd start to depreciate it from there. Okay. But you look at that whole little scenario that you just gave me, and you could say, but John, that piece of land was a hunk of junk. I mean, nobody wanted to hang out where the Giant Stadium is, the San Francisco Giant Stadium is, before they put the stadium there. It's like, okay, you can go there, have a couple drinks, come out after you're done and get mugged if you want to, okay? Then what, you put a stadium there, and now that piece of land where the stadium is sitting and everything is like, oh, this is prime real estate, right? Still carried a historical cost. What did you pay for it? What cost did you sink into it in constructing that building? That sets your historical cost, and then you depreciate from there. You can sell it for whatever the market will bear. Yes, sir. So once I, build my building, let's just talk about a house. It's kind of easier for us to wrap our heads around, right? What happens? You sit there, you buy a house in 1975, you pay $50,000 for it, right? Oh, God, $50,000 for a house? Well, that was a lot when you could have bought a house probably, 20 years before that for, $5,000 or something, okay? I mean, all this whole thing about homes and the prices of homes and all that, thank goodness for something called the Federal Housing Administration, FHA. What FHA tells banks is if you make a loan and you follow the proper procedures to make a loan to purchase a home and that homeowner can't pay, we'll guarantee that loan. That started around 1934 after the Depression. And what happens? Prior to that, if you wanted a house, you had to pay cash. Okay, so what happens? Once FHA says that they'll back the loans, now I can borrow the money for a house, right? Can I park an old car in front of a new house? No, I got to go get a new car to park in front of an old house. Can I put an old couch in a new house? No, I got to get a new couch. Did you hear they got these things now, washing machines? Really? I got to go buy a washing machine. That expands the economy tremendously, doesn't it? And so that's why they make a big deal out of the housing market all the time. You always hear them talking about housing market. It drives the economy to a large extent. So when you look around at all these houses all around, that's FHA. That's 1934 when they created the FHA. Before that, home ownership was like good luck. Okay, and so we have this home. Let's say we buy it in 1974 for $50,000. You look now, the same house is worth $2,050,000. But what's happening on on my personal balance sheet? I'm carrying that at $50,000, right? Then I sell it. And what happens? I remove that $50,000 from my balance sheet because I don't own that building anymore, do I? That house anymore? Now what? Now the new owners will put that house on their balance sheet at what? $2 million, because that's their historical cost. That's what they paid for it, right? And then if they sell it 20 years from now for $5 million, then what? They remove the $2 million and the new people put the $5 million on their financial reports. When they buy it, that becomes their historical cost. Huh?
Are the taxes just higher for that person, though?
The property taxes? Yeah, the property taxes would be based on their purchase, on their value, whatever it is that they bought it for, their historical cost. Actually, theoretically, the counties are supposed to go around and reassess the value, but they realized they would be spending their whole lives reassessing values if they did, so they pretty much stick with whatever the original cost was, and it's rare that they'll come in and say, hey, now your house is worth this, and you have to pay it. Now, from what you could do, and a lot of people did this around 2008 when the financial crisis hit and the value of properties were dropping, a lot of people went and applied for a reassessment of the value of their house so they could pay lower property taxes. But that has nothing to do with the financial reporting that we're talking about. Okay, that's just simply the county tax records and what they're saying the value of the house is. By the way, you look back at 2008 and you hear a lot of criticism about a lot of the programs that were put into place at that time, like the Troubled Asset Relief Program, et cetera. When President Obama came in, he came in with something called Making Homes Affordable. And a lot of those programs were designed to keep, when a bank loans you money, they know they have the loan backed by FHA, right? But what they do is they take those loans and they bundle them. They take your loan, my loan, your loan. They bundle them and they sell them off to either Fannie Mae or Freddie Mac that create securities that they're then purchased on the open market by investors. And what happened is when people started defaulting on the loan, the underlying backing of those securities that were being bought went under, and so the securities were becoming worthless, and the investors were saying, we're not buying any more of those securities. So what they did to really save us from going into financial collapse, another Great Depression, is they put guarantees behind the investors of those securities saying, go ahead, keep buying them. If they go worthless, we'll back them. And that kept what they call securitization markets open, and that's what saved us from going over the edge. Make no mistake, they may look at it now and say, oh, well, they did all these dumb programs. Easy to say. That's sort of like, when you almost have an accident and you say, oh, and you're like this for a second, and then as soon as you realize you're not going to die, you start speeding again, right? And you say, okay, well, that won't ever happen, okay? But it was touch and go there for a while with the economy towards 2008. You guys were probably like, what, 5 at the time, right? Huh? 9. Oh, okay. 9 or 10. So you're like, does that mean we won't get any more toys? Okay, right. So, but it was scary for a while there. And I think a lot of people don't realize how bad it was. I was on an assignment because what happened is my office, the Government Accountability Office, was required to every 60 days look at how that whole process was working and reporting back to Congress. And so I got put on an assignment where we had to look every 60 days at what was going on. It was horrible. The only thing I can tell you 60 days later is how much drier the paint is. Okay, there was really nothing that I could develop in a finding there. I'm not going to talk too much about myself here, but my talent was that I could walk into a room, and if you described your internal controls to me, I had an ability to go, that's not right. That's a problem. They said, did you hear what they said? I'd walk out of the meeting, did you hear what they said? Da-da-da. No, John, they said that? Yes. You didn't hear that? And so then we would build up from the wreckage to find out how that happened, and that's how we would write a lot of our reports. But 60 days later, all I can tell you is, well, they were here in this new program. Now they're here. There wasn't enough time for them to screw anything up within that 60-day period, so I didn't care for those assignments. But I did get put on some of those, and it was pretty bad with the securitization markets, et cetera, there for a while. Okay, any other question? Okay, historical costs for what? Fixed assets like buildings, et cetera, land, fair value for things like marketable securities, stocks that have a readily determined market value. Okay? Okay, good. Monetary unit assumption. What does this say? When we're going to require companies to put information in their financial statements, it's dollars and cents. Okay? FASB doesn't come up with a requirement that says in your financial statements when you list land, you have to say really, really, really big piece of land. No, it's what? You list land, you list the dollar amount. Now, that doesn't mean that we can't require footnote disclosure that give you some information, some words that go along with that. But in the financial statements themselves, it is what? Dollars and cents, monetary unit assumption. Economic entity assumption, what happens here? Here we say that we do not commingle the assets of the company with the assets of the owners. We do not commingle the assets of the company with the assets of the owners. So let's go back to our business that we said as a sole proprietorship was a barbershop. Remember we said barbershop? Let's say we have a barbershop. Did I mention that as our business? So we have a barbershop, okay? And let's say in my barbershop, I have the barber pole, I have a couple of barber chairs, the building, all that. Should that be on the financial statements of the business? I have a barbershop. I'm going to prepare the balance sheet of barbershop X, John's barbershop. Don't judge me by my hairstyle. The worst thing in the world, my dad is 88 years old. I got to take him like every month or so. He'll say, "Hey, son, I need a haircut." And I got to sit there watching my 88-year-old dad getting a haircut. The stupidest thing in the world. What happened? Okay, so anyway, so what happens? You sit there, and we have this barber shop, and we have what? We have the barber chairs, the barber pole, the building. Are those assets of John's barbershop? Yeah, I'm using them in the business, right? Okay. Now let's say I invite you to my house, and I say, "Hey, it's going to be a party, man. It's going to be great." I wouldn't do that, but just pretend. I'm going to have not you guys because you're my students, so I wouldn't do this, but I have my friends, whatever, over to my house. And in there, we have a 1900s barber chair, and everyone comes in there, and we recline that thing back, and I pour shots down everyone's throat when they're sitting in that, sitting in that barber chair. And, wow, this is great, right? Okay. Is that 1900s barbershop part of the assets of John's barbershop? It is not, because what? It's at my house and it's personal use, isn't it? So if that's the case, I don't put that on the balance sheet of John's barbershop because it's my own personal asset. We do not commingle the assets of the owners with the assets of the business. With me so far? With me so far? I'll take that as a yes. Yes, sir.
It seems like it's almost subjective, though. Like, what if you bring the barber chair, the 1900 barber chair, to the barbershop sometimes?
You're right on with me. I'm going to ask you to answer that. I'm going to give you the scenario. So let's say I quit drinking. I'm like, okay, this partying thing, I got to slow down, okay? And I realize the barber chair is the culprit, is the root of all evil. So I take that barber chair and I bring it over to my business, and now I start using it in the business. Is it an asset of the business? Now, because I'm using it in my business productively, maybe I'm saying, hey, normal haircut is, how much they charge for a haircut? I don't know. $12. Now I'm going to go ahead. Is it more than that? Huh? All right, I'm saving some money. Okay, so whatever the price of it is now I say, well, normal haircut is $30, but if you sit in the antique barber chair, it's $45. Well, now I'm using it in my business, right? So now it would become an asset of the business at that point. Okay? So yeah, it's not so much subjective as it is the intent. Am I using it in the business or am I using it for personal use? But we do not commingle the personal assets of the owners with the assets of the building, of the business, excuse me. Okay? Okay, good. Cost constraint. When FASB is deciding whether or not they should put information in the financial reports, they outweigh the cost to the company of providing that information versus the benefit to the users of the financial statements. Okay? So what happens? It would be very costly to ask a company to list every single one of their assets on their financial reports. They'd have to go through a process of listing every single asset, and let's say it would be useful if you told us what year you bought your assets, and you have to list that in your financial reports, let's say. There would be a certain cost to what? To FASB, to companies to put that information in financial reports. Meanwhile, investors may look at that and say, well, you know what? Even if you put that in there, we're not going to hardly look at that. So FASB looks at that and says, no, we're not going to require a company to go through all this effort to put a bunch of information in the financial reports that at the end of the day, users will not necessarily find very useful. Cost-benefit consideration. Okay? Okay, good. Okay, so we have these financial reports that we're going to be looking at. FASB uses some of those principles that we just looked at in writing the generally accepted accounting principles. Companies follow those when they prepare their financial reports. Auditors do what? Come in and check to make sure that they follow those principles, et cetera, right? All over the watchful eye of the Security Exchange Commission, making sure that that whole process is on the up and up. Okay, so let's look at these financial reports, and this should look familiar to you, even though they call it the operating statement. Remember I said we'll call it income statement? We'll call it income statement. And remember we had revenues, we had expenses, we had net income. When I said remember when we were looking at Apple? Obviously what? Much smaller numbers, easier to understand, but same concept. Income statement has what? Net income on it. Income statement, net income. Revenues minus expenses gives us net income. Important measure as to the financial success, financial security, whatever, of a company, right? Just think of it in your own terms. Let's say I offer you a job making $100,000 a year. Too low for you guys? Not too bad, right? Starting out anyway, 100,000. When I started out, I started working for the GAO. My starting salary was $13,000 a year. What's the first thing that happened when we found out my starting salary was $13,000 a year? I got dumped by my ex-wife. Okay, that was the first thing that happened. Okay. Why is that funny? Okay, all right. It was that and the receding hairline, I'm sure, were the two reasons. Okay, so what happened? So that really happened, guys. Okay, then what? Then I sat there and I was like, oh, okay, if only I could make, 30,000, I'll be rich. 40,000, I'll be rich. 50,000, I'll be rich. So the moral of this story is, it's never enough. Okay, there's always a wish that, well, maybe there'll be a little more that'll be coming. If you make $1 million, you'll want $5 million. Okay? Even they think it's funny. Look, the whole university is laughing because I got no. Okay, so so you sit there and I'm offering you a job $100,000 a year. And then you're excited. You say, oh, that's great. And I say, however, it's going to cost you $120,000 a year to get there. What are you going to say? No, thanks. This isn't worth it to me. This isn't worth my effort, right? Well, that's what that income statement is trying to tell you. They're sitting there and they're saying, hey, here's what we make for all our efforts, but we spend what? We expend this much in our efforts, and okay, looks like, and this is for a month's period, this company at least is making some money, right? Now, would you invest in a company that had a negative net income? Let's say that number was a negative number. Where'd it go? Right here. This 2,750, let's say it was negative 5,000 or negative 2,750. Would you invest in them? Maybe. Would you?
Depends on what stage of growth they're in.
Right, exactly. Tesla, negative numbers every year, right? But what happens? Negative net income every year, net loss every year. But what happens? Their stock keeps going up in value, doesn't it? Okay, so you sit there and you say, why, if they're having this negative net income? Well, if you read their financial report, the big expense item for them is research and development. So what are they doing? They're doing all sorts of research, etc., that eventually is going to yield larger net incomes, larger values in the future, and so people want to get on for that ride even though there's a negative number, right? Okay, so we typically would like a positive number here, but I just want to throw that out there that in certain stages, like you say, sir, of the company's growth, et cetera, we might accept a negative number there, right? But typically we're looking for what? We're looking for a positive number. Okay, now we come over and we look at our something called the statement of retained earnings. Retained earnings is basically where we report the earnings that we have held since the beginning of the company. It's where we report the earnings that we have held, the net incomes, if you will, that we have held since the beginning of the company. And so you look here, and this company just started business this month, September 1st, so their retained earning balance has to be what? 0, because they just started. They've never had earnings, right? Then we take the current period's earnings and add that to the beginning balance, which in this case was 0. This gives us what? Now this positive $2,750 balance. Company just started, didn't it? Company just started, so have we had a chance to retain any earnings? The company just started? Company just started, we haven't had a chance to retain any earnings, so our beginning balance and our retained earnings is 0. We have our first month of operations. We have net income. You should invest in us instead of Tesla, right? We have net income. You know, there's a lot of things that investors look at when they decide whether or not to buy a stock. The financial reports is only one of them, okay? But anyway, we sit here and we have this net income $2,750. So now we have retained earnings of $2,750 because we've got that first month of operations. We had income. We've retained $2,750. With me so far? Okay, then what? Periodically, I may decide to distribute my earnings out to my shareholders. I may decide to divide my earnings out to my shareholders. When I do that, when I divide, and I'm saying it weird on purpose, when I divide my earnings out to my shareholders, that is a dividend. I am dividing my earnings out to my shareholders. So if I am dividing my earnings and paying them out to my shareholders, am I retaining them? I am not retaining them. I'm paying them out, right? So we subtract the dividend from my retained earnings, and that gives me the ending balance of retained earnings. A month later, at September 30th, is now what? This $1,450 that's remaining that I have retained. So retained earnings is what? All of my net incomes over the life of the company minus what? All of the dividends I've paid out over the life of the company, and that gives me the ending balance of retained earnings. Yes, sir.
And is that in this every 10K? Or?
Well, this is a monthly report. In this particular example, remember there was the quarterly statements, the Qs, and then there was the 10K. He pointed out to me, hey, you got to search by the year to find the K. And so the quarterly statements are the accumulation. The Qs are the accumulation. There's 4 of them, and that gives me the K. Okay, and so it really depends what quarter did I pay the dividend out that I would report that subtracted the dividend.
So you only report it when you pay the dividend?
You report it in the period that it was paid. That's correct. Well, in the period it was declared, not paid, because there could be a difference between when I paid and when I declare it. So it's in the period declared that you subtract it from the retained earnings balance.
Thank you.
Mm-hmm.
What does a dividend look like to an investor? Is it like literally a check?
Just a check.
Oh, really?
Yeah, it's a check per share. So they'll declare a dividend, making this up, $5 per share. And if you hold 5 shares, you should get a check for $25.
Oh, that's pretty dope.
Huh?
Oh, I said that's pretty cool.
Yeah, it should be a check or direct deposit, whatever, however you've set that up. Well, for people your age, you're not so much investing in a stock that's paying dividend. Okay, you're not investing in income stock. Someone my age is saying, I'm going to buy a stock where it looks like they're going to pay out some dividends because I need to sit at home in my backyard staring at the wall, whatever, right, all day, and I have to have that check that comes in, right, where you guys are like, oh, I want a stock that maybe they're not paying dividends because they're reinvesting the money in the company is growing, and I plan to have that stock that I paid $100 per share for be worth $1,000 per share 10 years from now or something. So it really depends on the objective of the investor as to how you would look at those dividends. Okay. Sometimes they'll pay a dividend out in the form, and well beyond the scope of this class, guys, other stock, more stock. Okay, so that's kind of, well, that's kind of a good deal. Think about it. If you had Apple stock and they say, hey, we're going to pay you a stock dividend, you might be, oh boy, I guess, unless they're going to keep up the business practice of, charging us, $1,000 for the same phone over and over again. I had a guy that he was going to do some work in my backyard and stuff, and he said, I don't want you to pay me, I want you to give me your cell phone. And I said, what? Give me my cell phone. He's like, well, he showed me his cell phone. The face was all smashed, right? He's like, okay, I get it, So what I did was I went ahead and gave him my phone, and I said, oh, I'll get a new one, right? I'm looking at the new phone I got. I'm like, you know what? This is the same damn phone. I mean, there's nothing new that I can really do here that I couldn't do with the one that I just got rid of, but it had a higher number on it. I don't know how sustainable of a business model that is. I mean, they're going to have to start to come up with, I'm thinking a cell phone that you kind of like you take the little thing and you just sort of plug it into your brain, right, is what should be next. They'll have a little port here for us, and we'll all, right, and then we just think whatever it is we want to happen. Okay, I don't know. All right, but anyway, so sometimes stock dividend might be quite the nice thing to get, right? And then they just issue additional shares of stock. Okay? All right, good. So we have that. We have our retained earnings. And then we go to our balance sheet. Remember Apple's balance sheet? And we said it has to balance. So we have assets equal what? Equal liabilities. Here's our liabilities plus our stockholders' equity, which is our common stock and our retained earnings. And that balance sheet balances. Okay? All right. So right now, I know that's a little bit we're going to go through an example here that's going to help you understand the way that whole thing worked. Right now, I just want you to understand income statement shows revenue minus expenses gives us what? Net income. Balance sheet balances. Assets equal what? Liabilities plus stockholders' equity. That's all you got to understand about this little discussion right now.
Assets equal what again?
Equal the liabilities plus the stockholders' equity. So in this example, the liabilities are $1,600. The stockholders' equity is $16,450. You add the liabilities plus the stockholders' equity, that's $1,850, and that equals what? The $1,850 of assets.
What is a liability?
A liability is your bills. Liability is your bills, and I'm saying it funky like that on purpose. Liability is your bills. And so you've got an account pay a bill. Those are your liabilities. Okay, and I'll be talking like that for probably the whole class just because we're going to keep hammering that in until we understand that our liabilities are our bills. Okay? All right, good. Now you come over. You want to take let's do this question. A business organization prepared as a legal entity under state law is a state law? Corporation. We talked about that a little bit last time, right? You incorporate in the state. A lot of companies will incorporate in Delaware because the ability to issue stock is a little easier if you incorporate in the state of Delaware. And so even though they may be a California company, they'll incorporate in Delaware because it's a little easier to issue stock there. Okay? Does the Security Exchange Commission still oversee that process? Is the Security Exchange Commission still involved in trading of those securities, I should probably say? Okay, so even though you form at the state level, the SEC still has the authority to oversee that process. Why? You're organizing the state, right? Well, why does the federal government, Security Exchange Commission, come in and stick their nose into it?
Because their stocks are traded across states.
Exactly. That's the exact answer I'm looking for. Interstate commerce. Because you can trade stocks across states, then the federal government has the right to be involved. Just like there's a federal Department of Transportation because you can drive your car into Nevada if you want to. No, I don't think so. I mean, there may be some process where you're going there for some sort of process, but no. No. The corporation could be in California. The members of the corporation could all be, headquartered in California or something, and you register through Delaware. Okay. When we have the guest speaker from Price Waterhouse, he can probably shine a little more light on that because I'm sure he's gone through that process several times with some companies. But no, you do not have to be there to be a Delaware corporation. Okay. All right. Good. So that's a corporation. All right. Do you want to take the break? Break, guys? Okay, because we're a little. Yeah, because that'll take us right up, and then we'll go. Or you want to wait a little while? Sorry, no, it's kind of cruel and unusual punishment to propose a break and then stomp on the brakes on it. Okay, so why don't we go ahead, 15 minutes, come back at 5 till? Okay? All right, guys, and we'll start with this discussion. Okay, guys, I want to go ahead and get us started back so that we get out at 11:20. Okay, jeez. All right, just have to remember to leave some of the stories behind, right? Okay. All right, so let's go ahead and start this. So see how we get up to the end of class. We handed out the attendance sheet. So make sure you sign in wherever it is. Where is it right now? So it's making its way to you. Okay, we're just going to pass it around. Please make sure that you sign next to your name under today's date. Okay, obviously. All right. And you can just put your initials, whatever. Okay, so we said that the balance sheet has what? Assets. It has liabilities. It has stockholders' equity, and that can be expressed in the form of this equation you see here, which is asset equal liabilities plus stockholders' equity. The balancing being that the assets will equal the liabilities plus the stockholders' equity. Thus, it's called a balance sheet. Okay, but let's try to understand a little bit about the elements here. Okay, we first have assets. Okay, and assets are things that have future economic benefit. Assets are items that have future economic benefit to the company. Future economic benefit. Okay, so is cash an asset? If you don't think cash has future economic benefit, please surrender it to me right now, okay? And you will say, well, no, I don't want to do that, because you know that it has future economic benefit. For example, your lunch. So cash is what? Your favorite asset, because you can turn it into any future economic benefit you want within the confines of the law. You can turn it into any future economic benefit you want, can't you? Okay, so cash is an asset. Is a building an asset? Yes, because I can operate my business out of it for maybe 20, 30 years, right? Is a truck an asset? Delivery truck? Yes, because I can use it to make deliveries, etc. Okay, assets have future economic benefit. Now, our liabilities are our claims against our assets. They are our bills. They are our bills. And then the owner's equity is whatever's left over. So let's think about this for a second. Let's say in one pocket you have $100. In the other pocket you have a $40 phone bill. A $40 phone bill. So you don't have the full claim to that cash, do you? The phone company has what? A $40 claim to that $100 cash, don't they? What happens if you don't pay them? They'll take your phone? Okay, well, I don't know. Maybe whatever. I mean, don't get me into a circular thing here. Let's just assume the only assets are the cash and the liability, the $40 phone bill. Okay? They could conceivably do what? Take you to court, and you're going to have to do what? Cough up that $40. Okay, if you don't believe me, just watch Judge Judy sometime, right? Okay, Judge Judy doesn't like it when people don't pay their bills. She says, you're going to pay this person today, right? Okay. So what happens? The claim against your asset cash are your bills, your liabilities. The claim against your assets are your bills, your liabilities, right? And then you have what's left over, your stockholders, owner's equity, and that cash is $60, isn't it? What's left over? After you pay the phone bill, you'll have what? $60 left over that is your equity in that cash that you have. Assets equal liabilities plus stockholders' equity. Will this equation go out of balance? It will not. We're going to be learning about a system in this class, and a lot of this class is procedural. We'll be learning about a system, procedures that have been in place since the 12th century to keep this equation in balance.
If your liabilities are greater than your assets, then like would it be possible to have, in theory, negative equity?
It would be possible in theory to have a negative equity, which means you got a problem. Okay, now in this day and age, they don't throw you into prison. There's no debtor prisons. You know, if you read, you guys ever watch, you know, around Christmas time, you watch A Christmas Carol, and everybody's wanting Scrooge to die because they're sitting there. And in those days, they had debtor prisons. That's why he says in there, are there no workhouses and all that kind of stuff? Because they would send you off, right, if you owed. These days, though, you're going to have a problem in that what? You're going to be followed around until you pay that. And eventually, I guess you could file for bankruptcy and have that discharged in bankruptcy, etc. And now we're getting into an advanced accounting as to how all that would be handled. But yes, it is possible to have a negative equity. And you'd have to figure out some way to work your way out of that. And there are, you know, Trump says that he's a genius because he figured out how to use the bankruptcy laws to get out of paying his bills all the time, you know, and he says, oh, I just use the laws that are available. So there's certain bankruptcy laws, Chapter 7, Chapter 11, that you can go ahead and reorganize under and get out of that negative equity situation if it were to occur. So yes, it can occur. And you have to use the law, the bankruptcy laws, to get yourself out of that hole. But they don't throw you in prison, in case you were looking a little worried about it. Okay. I have a friend that has a negative equity. Is he going to go to jail? No. Okay. So they won't throw you in jail. Okay. All right. So assets equal liabilities plus stockholders' equity, right? The $60 is our ownership in our assets. There's a $40 claim against those. We call those our bills, our liabilities, right? Okay? All right, so that's basically each slide was intended to describe each one of those. But I want to get to this slide. Okay? All right, I know it looks scary. It looks scary, but it's actually very simple. Okay? So let's say I'm in a situation where I'm sitting at my house and I'm broke. I've got no money coming in. And I'm sitting there and I'm saying, I don't like this situation. I don't like the idea of not having any money come in. And I'm trying to think to myself, how can I start to make some money? So I look in my backyard and I see that I have a lemon tree there. And there's 20 lemons on the tree. And I paid $20 for that lemon tree. I paid $20 for that lemon tree. There's 20 lemons on it. So the lemons are worth $1 each, aren't they? Okay, they're worth $1 each. And I say, I know. I'm going to form Lord Lemon Corporation. And I'm going to bring this lemon tree into the business. And I'm going to sell lemons. That's how I'm going to make some money. So I go ahead and I bring the what? I bring the 20 lemons, $1 each. We're $20 into my corporation. I now have an asset. I have future economic benefit. I have those 20 lemons, don't I? And the future economic benefit is that I could presumably sell those later for some amount. Okay? Now, at this point, I don't have any bills. I just started. I just brought the lemons in. But I go ahead and I issue myself some stock. So in my owner's equity, I have stock of $20. Now, why did I issue myself that stock? I incorporated, didn't I? So I brought the assets into that separate economic entity, the corporation, and they're sitting there in the corporation. But I want evidence. Well, who owns that? Well, the corporation owns it at this point, doesn't it? Okay, but who owns the stock of the corporation? I do. So I'm taking back stock that evidences my ownership in that corporation in exchange for what? In exchange for the assets that I put into the corporation. So I put the assets in the corporation. Corporation does what? Issues me stock. And on the corporate balance sheet, they're going to show the lemons, the assets of $20 equals no liabilities, owner's equity, stock of $20. This balance sheet is telling you that there are people out there that hold the stock as owners of this business. Now, it so happens, since I'm just starting out, and this is a little lemon tree thing, that it's just what? One guy who holds the stock, me. But when you look at this balance sheet, you know they have assets, $20 worth of lemons. They have what? They have owners out there who own those assets entirely in the form of what? Stock that has been issued to them. And you know that right out. Now, do you want to invest in this company? I'm serious. No. Do you want to invest in this company right here? You're looking at that and you're saying, well, I don't know. I mean, $20, and you find out that $20 are lemons, and there's this stock, and you're sitting there saying, I have no idea. I mean, what's the business proposition here, right? So I say, well, you know what? I'm going to be in operation for a year. I'll show you what my financial reports look like at the end of this year, and then you can make your decision if you want to invest. And you say, okay, go for it, okay? So what happens? I go and I pick all the lemons off the tree, and I'm thinking, okay, the lemons cost me $1 each. I obviously want to sell them for more than they cost me, don't we? Otherwise, I'm wasting my time. So I decide I'm going to see if I can sell these lemons for $3 each. So I come up with a plan. I think, you know, if I start spinning these lemons and I get them to spin, and now I've got spinning lemons, people are going to come up and go, spinning lemons? Are you kidding? I'll pay you $3 for those. And it's all about my ability to keep all those lemons spinning at any point in time. So I've got talent here, don't I? So I'm sitting there and I'm spinning the lemons, and sure enough, here comes at least enough people that they purchase 5 lemons at $3 each. And I'm thinking, geez, those lemons only cost me $1. The spinning thing's working, right? And so what happens? I get revenue, 5 times 3, I get revenue of $15. I got some revenue. When you make money in the line of business that you have chosen, which in our case is sale of lemons, you call that revenue. My revenue is what? $15. If we're selling cell phones, that's how we make our revenue, right? Okay, but here we've got revenue, $15. Now, what happens? There was a cost to those things we sold, though, wasn't there? So we would report what is the cost of the thing we sold. And remember, we had cost of sales on Apple's report, and they called it gross margin. They called it gross margin. I said gross margin or gross profit. So we subtract the cost of whatever it was that we sold. It was $5, 5 lemons, $1 each. And so now we have a gross profit of $10. I think Apple called it gross margin. Those are synonymous terms, gross profit, gross margin, but it's showing you what's left over after we've paid the cost of whatever it is that we sold to you. Now, investors think that this is a very important number, because if they look and they see that what? That gross margin is very, very thin, are you going to want to invest in this company? You're going to say, you know, they're barely scraping by, just paying for what they are selling. Can I make any revenue if I can't purchase what it is that I'm going to sell you? No, and if I've got this razor thin margin left over, gross profit left over, there's not going to be much left over for potential investors to get dividends or perceived growth in the stock or whatever, right? Okay, so we're looking for this number to be fairly healthy, and I'd say $10 off of 15 is pretty good. Okay, so we have this $10 sitting there. Then what? Then I look at my lemon tree, and I notice that since I picked the lemons, it's looking a little tired out there, right? And so I say, you know what? I'm going to go to the fertilizer store and buy some fertilizer, because I got to keep that asset growing, don't I? So I go and I buy some fertilizer. take it home. I pay $7 for it. Take it home, and I dump it on the ground next to the tree, advisably. Okay, so I go ahead and I dump it on the soil there under the tree. I dump the whole bag. I dump the whole bag. Is there any more future economic benefit in that bag? There is no more future economic benefit in that bag, so I call that an expense. Notice it kind of sounds like the word expire. Future economic benefit has expired, so I will show that as an expense. And I'm saying it funky like that on purpose. Expire, expense, right? So I show that as an expense on my income statement. Revenues minus expenses equals what? Net income of $3. Not bad for a year's work. Net income is $3. Now you look at that net income number, and you're a potential investor. Do you feel a little bit better about investing in my company now? Now you're saying $3 ain't gonna, exactly throw me over the top, but at least the dude has turned what? Has turned these lemons that he had into what? Some income, right? So he's doing something. He's not going backwards. He's turning it into income, right? Okay, so now I go ahead and I prepare my balance sheet, and this is going to be my end of year balance sheet. Beginning of the year was what? 20 lemons, $20 common stock, right? Okay, now what do I have? Well, now I have lemons $15 because I did what? I sold 5 of them, didn't I? I had 20, I sold 5. So now I only have 15 lemons left at $1 each, future economic benefit. But now I've got $8 of cash. Isn't that beautiful? I got $8 of cash. I've got what? My cash sales of 15, right down here, guys, minus the fertilizer, which was $7, leaves me what? $8 of cash. So my assets are 23. Don't overthink it. 15 lemons. $8 cash, this is how I got the cash, right? Assets are 23. Have I issued any more common stock at this point? I have not. It's still the $20 common stock that I had at the beginning, right? But there is an increase in wealth, which is my net income for the period. And that increase in wealth goes to the shareholders, doesn't it? I mean, this is why we started this whole thing, is to increase our wealth. And so we call that increase in wealth retained earnings, and my retained earnings is now going to be what? $3. So the stock is still 20. Now the retained earnings is $3. The stockholders' equity is 23, isn't it? Stock plus the retained earnings is my stockholders' equity, 23. Assets are what? 23. The balance sheet balances. Question? We have revenue, 15. We have the cost of lemons, which is just the lemons. It was the asset that we gave up, lemons, not cash, right? Those are the lemons. That's $10 gross profit. We spent $7 cash on the fertilizer. So we're not going to, when we're calculating the cash, we're not going to consider the lemons because they're not cash, right? If we wanted to do the lemons, it'd be 20 minus 5 is 15. I just sort of had you doing that in your head. But the cash I wanted to write down here because it's a little harder to kind of do that in your head. So cash is $8, lemons is 15. Assets are 23. Stockholders' equity is 23. There's no liabilities, right? So the stockholders' equity is 23, which is the common stock plus the retained earnings. Question right here.
Could you clarify where the $20 in stock comes from? Like at the very top right?
The $20 in stock is me simply issuing stock to myself. So I do what? I go and I have, and let's say the state says, John, you are authorized to issue $100 of stock, and each share of stock is worth $1. So I sit there and I say, this is all the stock that I'm authorized. Hope this isn't anything embarrassing. This is all the stock that I'm authorized. And I say, okay, let's say this one big piece represents 20 shares. I now own 20 shares. The corporation is still authorized to issue, what it would be, 80 more shares out there. But right now, $20 worth of stock sit in the pocket of John Lord. And I am, at this point, the entire owner, the sole owner of all the assets of that corporation, right? The stock. So here's what I could do. I could forget about the selling of the spinning of the lemons right now. In fact, no, I don't even have to forget about the spinning. You look at this beautiful financial statement up there, and you say, I get it, $3 spinning lemons. You say, I'll tell you what, dude, I'll buy that stock from you for right now for $23. You say to me, I say, deal. I take the stock, I issue it to you, you give me $23. The common stock that is outstanding is still how much? It's still $20 of common stock that you're holding right now, even though you just paid $23 for it. And you're saying, well, why would somebody do that? Well, they're doing that because they've got $23 worth of assets, lemons and cash of 15, right? 15 of lemons and $8 of cash. There's $23 of assets, so you paid $23 for it, right? Of which $3 is retained earnings, $20 is the common stock that you're holding. Now you hold the stock, and I walk away, woohoo, $3. You're holding the $20, right? For the stock? You can throw that away to take it back. It's not really stock. Okay, so what happens? You're sitting there, and you're holding that. Now you're going to take over the spinning thing because you're thinking to yourself, I can make those lemons spin even faster than this guy can. He had a great idea, but he's not very good at managing the business and stuff, and we're going to take this over, and we're going to make this grow from here. Now you own it, right? So that $20 simply evidences what? The stock that's outstanding that are in the hands of investors could be me, could be you. I could issue some more stock. I could sit there and issue all the rest of that stock. Now common stock would be $100, and I'm assuming cash would be $80 because I'm assuming I would get the cash from you guys for $80, and the balance sheet would still balance, wouldn't it? Because the cash would go up, the stockholders' equity would go up. That's exactly correct. The question is, on the balance sheet, I'm going to repeat in case folks in the back didn't hear. The question is, on the balance sheet, we show the book value, what we issued the stock for on the balance sheet. That's correct. So just for now, because there's a little more to it than that, but not really much more, the common stock is whatever the par value was of the stock, whatever we issued it for par. Increases in the market value of the stock do not affect what's on the balance sheet for the stock, what you're calling the book value. That's correct. So the market value may go up and down in that stock, but it didn't change. It was still what? Par value was $20, right? Okay. Okay, good. So we get through the first year of this company, and we get out 1120. So we're going to stop right there. We're going to turn it into a murder mystery. So what happens next year, okay? And so what we'll do next time, guys, because the timing's not great, we will, hang on, guys. We will go and look at, we'll start this again. We'll look at this again next time and go into year 2. And then we'll start getting into the situation where we'll have some quiz questions and stuff to look at next time, all right? A couple things, reminders. I would recommend, make sure you sign in. The sign-in sheet, where is it right now? Wherever it is, it's coming forward then. Okay, so make sure you sign in, and then I would highly recommend that you get on that URL and buy the, not buy it, but for free, try the textbook stuff, even though it's optional. Go ahead and try it and take a look at it, and I think you'll find some use out of it early on here. Okay, guys, I'll see you on Monday. Thank you. Thanks, guys.